Welcome, and thank you for joining our annual Business Outlook with a focus on the future of energy. My name is Lillian Mills. I'm the Dean at Texas McCombs, and I would like to briefly introduce our panelists. You can find their full biographies on the event website. First, we have Garrett Golding. He is a business economist at the Federal Reserve Bank of Dallas. In this role, he analyzes trends in energy markets, geopolitics, and the U.S. shale, oil, and gas sector. He also briefs the Dallas Fed president on these issues for meetings of the Federal Open Market Committee. We also have Chris Manning, the managing partner and CEO of Greenbelt Capital Partners, which he founded in 2021. Previously, Chris was a managing partner at Trilantic North America, which he joined at its inception in 2009. Chris earned his BBA from McCombs, serves on our McCombs Advisory Council and our New York for McCombs Executive Committee. Michael Weber is the Josie Centennial Professor in Energy Resources at UT Austin and CTO of Energy Impact Partners, a $2 billion clean tech venture fund. Michael was recently based in Paris, France, where he served as the Chief Science and Technology Officer at ENGIE, a global energy and infrastructure services company. So let's get to our discussion. In the past, financial subsidies were put in place to encourage investments in new energy technologies, but today there's a new source of support in the form of ESG-focused investment dollars, looking for technologies that satisfy goals beyond profitability and reliability. And this new force raises some important questions we'll talk about today. I want to start looking backward and then shift to the business outlook that we're here for today. And Garrett, with you at the Federal Reserve, I want to start with you for some perspective. Looking back to 2020 and 21, can you refresh us about how the pandemic affected energy markets and what other shocks exacerbated that effect?
Sure, and thank you for having me on this great panel. I've been looking forward to this for a while. And also for everyone, be forewarned, I had to stay home today because of the roads up here in Dallas, and I have a 3- and 5-year-old lurking somewhere around the house. So hopefully that doesn't become an issue. So I hope to answer this one succinctly because it's been somewhat of an unprecedented couple of years here for oil markets. And let's start with the beginning in 2020. Oil market was kind of a house fire at the beginning of the year because of the pandemic's initial blow to demand. But then there was this price war between Russia and Saudi Arabia that followed. And if the house was on fire, that was the meteor that came and just blew the whole thing to pieces. If you weren't following this back then, OPEC couldn't come to a supply agreement at the March meeting. And in response, Saudi Arabia ramped up to 100% of its production capacity. That flooded the market and crushed prices. None of them at the time realized what COVID was about to do to the global economy and to global demand. So it was really a catastrophic blow to the oil market that spring, which is having an impact today. That's why I tell that whole story. Even if you're an oil market person, you probably remember on April 20th of 2020, WTI closed at negative $37. And the market has slowly crawled out of that hole ever since, with some fits and starts. And now we're hanging into the $90 and above range. So how did we go from negative 37 to 92 this morning? Oil companies all over the world, but most importantly, shale producers here in the US and national oil companies across many OPEC countries, they slashed their capital spending across 2020 and remained cautious throughout 2021 because of the hit that they took and also the risk of another price washout with all the different waves of COVID that we've had. Shale companies were also much more disciplined in how they spent their money, strictly living within cash flow instead of outspending it, which was their prerogative for the last decade. And this greatly reduced the pace at which they can grow production. Meanwhile, the past few years of underinvestment damaged the production capacity of OPEC, and that group has failed to meet production quotas for the last several months. As a result of all this, global inventories plummeted over the past 6 months of last year and led to a big surge in oil prices from $50 to $80. We're now in this $90 range because of geopolitical tensions with Russia, and continue, low crude and product inventories. And then the cold winter across the Northern Hemisphere isn't helping things either. So with COVID recovery well underway and production capacity remaining tight, barring some kind of widespread economic slowdown, we're anticipating that we've rebalanced into this $80 to $100 level for the rest of this year.
Okay. Well, that's Garrett. Thank you. It's a nice segue to talking about 2022, since you said this 80 to 90 might persist. Can you give us a little outlook around GDP, inflation, anything more you want to say about oil supply and demand, and anything specific to Ukraine if you feel comfortable sharing about it?
Okay, so yeah, a few things to cover here. And to be clear today, all the reviews that I'm speaking about are my own, not necessarily that of the Dallas Fed or the system. Mm-hmm. And I can't make predictions on monetary policy or something like that, and decisions that are coming forward. So that being said, the FOMC in December, their projections were for U.S. GDP to average 4% this year. And historically, that's well above trend, but it's still, coming down from really the scorching level that we were seeing at the end of last year. The FOMC also expects PCE inflation to average 2.6% this year, and employment to average 3.5%. At the Dallas Fed, our team of economists are expecting inflation to be a little bit higher than that. And if you're following this topic closely, you probably see higher numbers out there among different research analysts and banks as well. We still think that's primarily going to be a supply constraint story for 2022, as the fiscal impulse in the US quickly phase out of the picture. Basically, people are going to be buying less stuff as they were over the last year. And this should help a little bit on the supply chain crunch that we've seen over the last several months, several quarters.
Yeah.
On the oil market, as I mentioned, supply is a lot more inelastic now than it has been over the past decade. So it's not going to respond to prices like we would have expected a few years ago. So if demand is going to return and surpass pre-pandemic levels, which we're expecting here in the second half of the year, stocks are going to draw even harder. And we could, that's what sets the stage for this higher price environment that we're expecting. The risk to this is that there could be a nuclear deal with Iran sometime this spring. That could bring back over 1 million barrels a day of oil exports from that country. That would go a very long way to help smooth out what we're seeing on the supply-demand mismatch. Or the economy could slow down faster than we expect due to inflationary pressure or interest rate policy, which could essentially slow down demand as well. So, while we do see a lot of the calls out there for $150 to $200 price oil price, some of that's a little bit sensationalist to me. I think those kind of predictions, forget what demand destruction is. That is, if you get to that 150 level, it's really unsustainable for this economy, where you start to have people travel less and businesses, unable to move product the way that they would like at those kind of energy prices. So moving on to Ukraine, my personal view is, I think with each day, we're seeing dwindling chances of a full military invasion, knock on wood. I don't think that, the Russians would give their adversary weeks or now months to prepare for this kind of thing. And that's what we're seeing, now with U.S. troops in the theater, not that that's in and of itself a deterrent, but, it just demonstrates how Ukraine has been able to marshal support, and we're getting a bit more of a focus from their allies to not do this thing. I think if they were serious about invading, they would have caught everyone by surprise. But if some kind of incursion were to happen, there would be a knee-jerk reaction in oil prices, but it's not really an oil disruption story. The sanctions that are being talked about have been, reportedly less focused on the energy sector, less broad than originally thought. And the real crisis is obviously going to be in natural gas, where exports to Europe could be cut off. If that happens, there's not a whole lot of good options. The U.S. is working with LNG suppliers to throw as much product to the continent as possible. We're seeing that play out right now. But if there's a complete shutdown of Russian exports, those measures can only really go so far.
Well, Garrett, I really appreciate so much depth on this. We teed up at the beginning that we might talk some about ESG, and I thought before I turn to Chris Manning and Michael Weber, you might want to frame how the Fed thinks about defining the concept of ESG and how it's generally impacting investment. And then Chris, I'll turn over to you.
Sure. So environment, social, and governments, it's an implementation of really a suite of improvements that the manner in which corporations conduct themselves and interact with society. I think you can kind of think of the forerunner to this as corporate responsibility, which was something that industrialists started 100 years ago. Mm-hmm. But ESG is, it takes that really to a whole nother level. And I think from our perspective, we're seeing it incorporating the environmental part of this more than the S&G. And this is especially the case with the energy sector, where we're looking at, flaring or other emissions and contributions to climate change. There's also what makes this much different than social responsibility before is there's an attempt to make this quantifiable and measurable, different ESG scorecards out there that investors and analysts use. And now there's a whole industry that focuses on improving ESG efforts at companies and providing ratings. And this goes a long way to determining where companies, especially in the energy sector, can raise capital. So it's having a clear impact on corporate goals and investment and where dollars are going to be spent and invested over the next few years. We've seen this really accelerate over the last 3 or 4 years, particularly.
So let me take that and turn it over to Chris Manning, because the question I want to ask you is, where is the capital flowing right now? How much into the oil and gas sector? How much is chasing whatever the investors think ESG represents? And does it matter whether the company trying to raise the capital is private or public?
Sure. So great questions, and we could probably spend hours on all of those, and I'll try to hit it in a couple of minutes. But I too am grateful for the invitation to be on this panel. So thank you for that, and good to speak to folks today. Look, just in terms of capital flowing, is it flowing into oil and gas and other sectors? Look, I think you'd just looking at the public equity markets over the past 12 months, you probably would think a lot of money is flowing into the oil and gas space, with individual oil and gas stocks up 2, 3, 4 times their money, maybe sometimes even more. Kind of more broadly, a large energy company index would have been up 50-60% in the last 12 months as compared to the S&P up maybe 15%. So that at a high level, you think money's flowing into the sector. That being said, energy still only represents 3.5% of the S&P 500. Now that's up probably from a little bit lower than 2% 12, 15 months ago, but it's still down a lot compared to maybe a decade ago, where it was somewhere between 10 and 15% probably. So it's really a small component of the overall market. When you kind of go at a little bit of a deeper level and just look at the public equity markets and energy companies going public or follow on equity offerings, you're just not seeing a lot of demand certainly for IPOs. I mean, there's only been a handful of IPOs over the last 3 years, and certainly in the upstream space. If you look at the high yield markets, a lot of investors chasing yield, of course. 2 years ago, only the best energy companies could have raised high yield financings last year. A little more volume and a little bit more open-mindedness, if you will, to let's call them, subpar, if you will, or, more questionable credits. But even that, all of that money is really just refinancing existing debt. So both in the public equity markets and the public debt markets, I would say, not a lot of new money coming into the space. You look at commercial banks who have been, traditional lenders and scale to oil and gas companies. They too are kind of pulling in their horn, so to speak, and reducing their exposure. And I think it'll be interesting as we watch kind of how some new nominees come onto the Fed and their posture around some of this, how it might change. At the highest level in the boardrooms of these big money center banks, I think we all know that they're reducing their exposure, and so that turns us then to the private equity markets, which I tend to spend a lot of my time in. You're still not seeing a lot of inflows into that space. Also, there are unquestionably interesting investment opportunities in the traditional oil and gas space, but with money managers around the world, making an effort to reduce their portfolios or companies specifically, related to fossil fuels. It's just that they're everywhere you turn, money is really leaving, kind of leaving the space. Is it, going into technology? Is it going to ESG, sort of focused endeavors? Yes, and yes, and a lot of other industries are benefiting from this as well. I was interested in Garrett's sort of, commentary on ESG, because while it is something that we've been talking about for a while, beginning with corporate responsibility, as he said, and there tends to be a lot of focus, of course, on the E part, particularly in the energy business. I think you've found that it's made operators a lot more responsible in how they operate, a lot more measuring going on, particularly in the public markets. But you see that certainly across our private portfolios, we've been doing this for a while, but it starts with measuring and understanding, what you're doing and how you can get better. And once you've measured, you can reduce. And if you can't reduce enough, then you can, start doing things like buying carbon credits to kind of get to carbon neutrality. I mean, you can take a JetBlue flight and they'll tell you on most of these flights that you're flying on a carbon neutral flight. And that may be hard to get your head around, but, folks are doing this, all across the board. I think what it means to be investing in ESG might mean different things to different people. You look at a company like Amazon that's in a lot of ESG, sort of funds or in portfolios, and yet Amazon, is emitting more carbon than most oil and gas companies. So what is ESG to one person may not always be ESG to someone else. And I think that leads to, some folks, whether it's rating agencies like Garrett was talking about, or the SEC, that might, start spending more time on this, and how and who can be branded as an ESG sort of oriented, investment option. I think that'll be interesting to watch, I guess, would be the small point.
Thanks, Chris. And before I turn it over to Michael, I want to put in just a small brag for my own colleague, Jeffrey Hales, who's the director of our Sustainability Institute, is the chairman of the Sustainability Accounting Standards Board. And we're better to be thinking about the importance of measurement to this whole problem than in that space where the business school works with engineering and elsewhere at UT. So, Michael, if Chris described some capital flow changes, if capital is flowing to ESG companies or ones who say they're improving environmental issues, how easy is it for debt and equity to be raised to finance projects outside of traditional oil and gas?
Great question. I'm just a dumb engineer who dabbles in these things. I don't really know in great depth, but I will say that the trends are very clear, which is that it gets easier with time. And if we back up a decade or so, oil and gas, well, for well over a century, generated the best return. So attracted all sorts of investment because that's where you can make a lot of money while lifting people out of poverty and doing all these great things for those individual consumers and those companies in the world. So oil and gas always had the best returns and the best value for humanity, attracted a lot of money. The viewpoint has changed in the last 10 or 15 years, where oil and gas is not generating the same returns it used to, as Chris said and as Garrett said. So the returns aren't quite where they used to be. And now there's pressure that maybe the good that oil and gas brings can be brought by other things. So the moral or ethical argument's not the same as it was a century ago, and the returns aren't the same. Meanwhile, there's this pressure on money to flow to different sectors in those sectors, which might be wind farms or solar farms or something, which have always generated lower returns, oil and gas. Now, all of a sudden, their returns, which are lower but are stable and less volatile, look pretty attractive. So a wind farm or solar farm might have like a 20 or 25-year fixed price contract, a corporate power purchase agreement or a PPA, and the price is set for 20 or 25 years. And so if you're a power company that is buying gas on a 1-month contract that changes month to month, and all of a sudden you get 20-year fixed price, that looks really good. So utilities are signing up for these fixed price contracts. So then if you're the developer, your returns are low, but they're guaranteed. And in an era where we go from negative $37 oil almost 2 years ago to $92 barrel oil, that volatility is expensive. So I would say that the developers of these projects, because of the way the resource operates, is a little more predictable and manageable, reduces volatility, gives you lower returns, yet it's still attractive anyway, just on the fundamentals, the financial fundamentals. Then you add in the ESG component, which is people kind of want to divest from this, invest in that. So I would say that the funding for these projects is getting easier with time, which is really incredible. And the more it happens, it becomes like a self-propagating thing. The more we invest in the sector, it drives down prices, which makes it easier to attract money. And the less we invest in that sector, the more expensive it gets, which makes it harder to get money. It reminds me a little bit what oil and gas is going through now, where if they go get a loan from a bank or wherever they're going to get their money, they're paying a higher price for capital than wind and solar farms. That's what nuclear has always confronted. Nuclear has always paid more for cost of capital than other places because its risks, which are different than oil and gas, are risks. And the lender might not be comfortable with it. They might feel like there's too much liability over the lifetime of the asset. So nuclear has always had this headwind, which is it has to pay more for money. And I think that's starting to hit oil and gas. And that will certainly affect where things flow.
So I think we could go from that question back over to Garrett, because Michael, you mentioned somewhere in there the issue of poverty. And so energy price volatility is felt more by some participants in the economy than others. I note Philip Herv in the Q&A just threw in a note that we have very high wind energy production in the last 24 hours. I'm not surprised it has been blowing up a storm for 24 hours across the state of Texas. But as the flows of capital change, Garrett, what view do you have about the portions of the economy that are very sensitive to energy price volatility?
So, I think we have to kind of draw a line also between volatility and high prices.
Okay.
Volatility, volatility is bad for everyone, for
Right.
producers and consumers. You would think, volatile prices, would also imply higher prices, which would be good for producing countries or, obviously producing firms, but they don't like planning, when on that kind of volatility. And that's, in some sense what we're seeing right now. The volatility we've seen over the last 2 years has really sucked capital out of investment in, major projects across the world, with deep water offshore or, national oil company projects, and then, the shale industry here. And, to kind of go back on what we were discussing a moment ago, and if, how this is all impacting prices, to some extent, I think we're seeing the impact of ESG on energy prices today, but in the economy, but it's with a bunch of other things going on. So it's a fact that there's less capital available for traditional energy companies, but at the same time, all these shale companies have changed their business model. They're not going to go out and drill more just because prices are higher, and so that's limiting how much they're willing to go out and produce more and deliver more, even under a higher demand environment like what we're having today. So, even until to go back on who this impacts the most, as we can all understand, higher energy costs are disproportionately going to impact poorer households and societies. And we have to remember there's over 1 billion people on the planet that don't have access to electricity right now, and who should be receiving it over the next few decades unless it remains unaffordable. There's over nearly 1 billion in China that are in the middle class, about half that in India now, who are going to be demanding the middle class lifestyle that we see in advanced economies. And that's predicated on affordable and reliable energy.
Right. So I'm going to pose this to Michael, but Chris, feel free to weigh in. What's the role of regulation to shape energy transition? Or do you think the capital markets will send us to the efficient solution in an appropriate time?
I feel like the capital markets are the dominant force right now. And the capital markets, broadly speaking, by that I mean the investor class, but also the consumers, also the employees are putting pressure on their companies. And so there's just a variety of forces at stake, from the private markets pushing companies to go a different direction for the cleanliness of their energy supply chains than they used to before. And I think that pressure is dominant. It's much bigger over the regulatory context. But the role of regulation is important, because the role of regulations can inhibit that pathway, can slow it down or speed it up. And I would say that the role of the regulatory context is to really give clear rules that are stable, that everyone understands. So that will open up investment. Investment will tend to stay on the sideline if there's a lot of political or regulatory uncertainty. In the United States, that means we can change the rules every 2 years with a new Congress, every 4 years with a different president. So the rules changed a lot from Obama to Trump, and from Trump to Biden, right? So these kind of changes create uncertainty, which slow down capital investment. So coming up with a multi-decade stable situation from policy perspective would really help. I think of like policy volatility is just as damaging as price volatility in many ways. So clear, easy to understand, directional policy regulatory environment opens up capital investment, but the capital investment's where the big money is. The US government is not the whole economy, it's a fraction of the economy. So we want the whole economy going a certain way. I would like to see better, clearer, more stable policies sooner. And the way I think of it is with the game, like a sports game, a basketball game or something like that, the referees have to enforce the rules. The rules are made by committee or whoever, but then you have competition within the markets to see who can comply with the rules and win. And what we don't want is the government as a competitor in the markets, but we do want it as a rule setter and a rule enforcer. And I think we're missing that clarity. I think we're headed that direction anyway because of the capital forces, but it could go faster and more smoothly. And then there are all these labor or social justice components, which is regulation can help make the transition smoother so you don't displace 40,000 coal miners, that kind of thing, all of a sudden, which would be disruptive for those communities and families. So there's a lot of reasons why there's value in having elegant policy context to avoid the really difficult displacements and disruptions. So I'm a fan of that. But we've seen a lot of regulation in the energy sector over the last 100+ years in the United States. Sometimes it has gone very well, sometimes it's gone very badly. And I would say that generally speaking, the United States is bad when it's trying to pick the fuel or technology or pick the price. I think that is a bad role for government. And there are times that the government has mandated that we must use corn-based ethanol, for example, or has prohibited that we cannot use natural gas for power plants. It has said you can't use this or must use that. That usually goes badly. It's also generally bad when the government dictates the price. I feel like it's better for the government to set the rules of the marketplace, protect our IP, invest in the innovation ecosystem, and then get out of the way, let the market sort it out. So there's a role for regulation and there's a role for the markets. And right now we're still kind of finding our way through that. I don't feel like we don't always agree on where government should begin or stop. And that's part of the political battle underway right now.
And Chris, I'm always hoping policymakers are listening to webinars like this. And I know that one's not your question, but I thought I would let you sort of double down with Michael if you want to make a similar plea to any legislators and policymakers about the need for clear, stable rules that are not creating the volatility in the system itself.
Look, Michael's always been a lot more articulate than me. That's why he's written books upon books upon books that I always enjoy reading. So I really don't want to add much to that, to be honest.
Okay.
I think you said it so well, but I will. I'll give you an anecdote, and it's an example of why policy needs to be clear, because it can be confusing. A simple example, although it'll sound quite political, but a pipeline in North America is not okay, but a pipeline in Europe is okay. And that sort of sends confusing messages to folks. And I just think, and this has been true for a long time, by the way. I think lots of presidents could have been a little clearer, and their administrations could have been a little clearer around what the policy actually is, the direction we're going. And look, maybe we'll come to this in Q&A, but we're big believers. I think most people on the phone probably are in the transition that we're making around the world, the energy transition. And I think we believe at Greenbelt, at least, that it might be a little slower than what other folks might envision. And not to say it's real slow, but with a little bit more kind of thoughtful pace, so to speak, I think we can do a little bit better planning. And when you rush certain things, it creates blackouts and brownouts and unintended consequences, both economic and political, geopolitical, in fact. So I've already said more than I intended to. I agree with about 99.9% of what Michael said.
Well, let's turn to the future. And Garrett, I'm going to go back to you. Your crystal ball to 2040, what does the energy mix look like? And let's keep them short so we can get to a few audience questions in a few minutes.
Yeah, for 24, I think when you look at transitions in fuels, I think you have to look at the history here. Look at coal. It was 65% of primary energy in 1920, and it's 25% today, but we're using 5 times more coal today than we were back then. So I'm not suggesting that we're going to be using 5 times as much oil 100 years from now, or even in 20 years. But when you look at the energy mix, you have to consider how many quadrillion BTUs of energy the world demands as a population and the economy grows, and still these billions of people that are in energy poverty. So that being said, by 2040, I think we do have a lot of renewables on the grid and a lot of electricity and transportation, but we'll still be using a substantial amount of petroleum, less than today, but probably not half of what we expect. And I think that may be a surprise to a lot of prognosticators and policymakers today. What could surprise me is I think battery storage. I think it's the key to unlocking what renewables transformation could be in the grid and in transportation, not just on the utility scale, but for households as well. There's a lot of interesting questions on distributed generation, which is a whole other webinar I'm sure that Michael would plow right into. But I think that could be a very welcome surprise.
Chris, how about you? Where are you going to be investing over the next decade, and how's that impacting what you think about the future energy mix?
Yeah, I'll just pick up where Garrett left off. I mean, we're big believers in what's happening with distributed generation and intermittent power, and battery storage is really the if there's a silver bullet in a lot of this, it's probably around storage as we make this transition off of fossil fuels in a more meaningful way towards renewables. So that would be kind of one theme. I'd say digitalization of the energy industry, where access to information, monitoring that information, plows right back into risk management and planning. So we see that as a big growth area. Demand response, energy efficiency. I mean, buildings are among the largest carbon emitters, right up there with transportation, the transportation sector. So there's a lot that's going to, come with that. The electrification of vehicles, we're already starting to see that, but we're hardly in the first inning of all that, and how vehicles might ultimately become storage devices and sell power back into the grid, and all the different changes that are going to have to be made, to the grid, quite frankly, to have bidirectional energy flow. So, I think as an anecdote, when we were more focused as a firm on the traditional energy space, you'd see, hundreds of billions of dollars of annual, capital deployment requirements. I think in the energy transition, broadly defined, it's 5 trillion a year sort of number. So 10x the amount of capital that's going to be required to take us where I think we want to be 30 years from now.
And Michael, where do you see the future of energy jobs?
That's a great question. And I guess you and I as faculty have this responsibility to offer instruction. And there's always a tension at the universities, whether we're supposed to teach or train. And if we teach, we're trying to convey fundamental understandings that get students to the position where they can really learn and think, which is great for long term, but makes them not so useful for their first job. And so companies complain that they're hiring these smart former students who have to be trained because they don't know anything. And so we are under pressure as instructors to train more. And therefore we train them more for the next job, but then that job disappears in 20 years and the student doesn't know how to think or learn. So we have to teach so that students are nimble intellectually for a 40-year career or whatever it is, but we have to train so that they can get jobs and be useful and this kind of thing. This is the tension. And I'll say that for us, we need to prepare for this long term. The jobs that exist 30 years from now, half of them, we don't even know what they are and they don't exist. Right. And so it's hard to speculate, but it feels to me like it's going to be more interdisciplinary, more international, and more data oriented. Like those are broad themes that I think about, that we need to get out of our disciplinary silos for our teaching. That engineers need to learn business and business needs to learn science and this kind of thing. Policy be more relevant. It's going to be more and more global. The energy system has always been global, but it looks like it's becoming more global as time goes on to me. And then it feels like data and the role of knowledge in sensing will just grow. That is a way for us to get efficiency. So that's what I think the future of energy jobs is, which is different and we can't even anticipate. So how's that for a non-answer?
So I've been watching the Q&A, and of course I have all the pre-submitted questions. Can we go around 30 seconds each? What about nuclear power? And what will it take to get it moving, or are you investing in some sort of belief that it will?
I love it. In energy, we call that the N word. Nuclear is something that there's no middle ground on. You either love nuclear or hate it. And if you look at nuclear in the movies, it either makes you a superhero like Iron Man or causes the end of society like China syndrome. And really reflects, I think, our view of it in America, which we can't figure this out. We love it because it's reliable, it's affordable, it's low carbon. We don't like it because it's expensive and we do whatever, all these kind of things. So we simultaneously think it's cheap and expensive. And I think if we care about carbon, we have to take nuclear very seriously. And the most decarbonized grids in the world are Norway with hydro, Iceland with hydro and geothermal, and France with nuclear. It's one of the options. And for us in the United States, it might not be the 1970s nuclear. It might need to be the smaller, more efficient, higher performing, more robust form of nuclear.
Chris?
Sorry about that. I was on mute. The only I would add to that is it does seem to be even more localized. You know, where some states in the United States are a little bit more, you know, open-minded to that for a variety of reasons. Some of that's related to probably workers and that kind of thing. But again, back to policy at a national level, I think we could afford to have a more I don't know, open-minded view around nuclear. I don't see it personally changing a whole lot one way or the other. You know, what we have, I think we're going to keep, and putting new nuclear in you know, in operation, I think is, at least in the short term, probably pretty unlikely.
So we have 500 participants online. I hope 20% of them, or even half, might be from outside Texas, but I do want to ask a Texas question. We had a cold 24 hours. We closed campus. What are you guys watching about the Texas power grid? And we don't have much time, so you can pick anything you want to answer. Do you think we'll ever join either the East or West national grids? Do you have confidence in the level of insulation that we're putting into the Texas grid? So Texas grid, 30 seconds, go.
I started drafting my op-ed this morning about Texas should reconnect and connect to the other grids because it would help lower prices for consumers nationally, it would help decarbonize, it would improve reliability. That's my view. Most Texans disagree.
Okay, Chris.
I think the Texas mentality is going to make that kind of hard, to be honest with you. I think there's a certain independent streak that a lot of folks have that ultimately might override that, in spite of all the good, you know, reasons for doing it. Like Michael said, I do think more money will go into things like insulation and protecting the grid so that we don't see what we had 12 months ago.
Okay, I'm going to go to some of the pre-submitted questions, and maybe Garrett, this is such a global question, you might want to take it. What company or class of companies do you see taking lead on new energy initiatives for renewables and transformation?
So as part of my job, I can't answer, you know, individual, I can't name names, but that being said, you know, I think that what you're seeing with some of the you know, the super majors and the oil companies, and particularly more of the European-based ones that are trying to see themselves and portray themselves and actually transform themselves into energy companies and not just oil companies, I think is a very interesting development. It's also interesting to see how it's received by investors over the last year. There's been some negative and some positive cases to look at, depending on who you're looking at. The thing is, you know, a lot of these companies have unbelievable engineering talent and computing, you know, ability and talent that lends itself to a lot of different things that are going to be necessary for the energy transition. And some of them are positioning themselves for that. And I think that's a very important development to watch.
And I had a question around what are the risks of stranded assets in oil and gas as renewables become more established? Michael, is that appropriate to you?
Yeah, stranded assets is not a new problem that's happened in the energy sector at various points over the decades. So there are regulatory pathways for dealing with stranded assets to shut things down early for some environmental or other reason why you need to shut it down. And then you roll it into the rate base if it's a regulated setup. If it's an IOU or competitive investment setup, then maybe you take it as a loss or something, but then it frees up your ability and social license to operate to build the next thing you'll make money from. So stranded assets are a real issue in the power sector, and for oil and gas becoming more and more of a risk. The main thing we need to worry about environmentally is leaking methane, plugging the wells. There's multi-billion-dollar initiatives there to stop that. But those same sites might be appropriate for carbon sequestration, not always, might be useful for repurposing for geothermal. Maybe instead of just shutting them in and stranding them, is there a way to repurpose? I think that's a great research question.
I have another question that's slightly related to the grid. It's exciting to live in Austin, Texas, and we, like Fort Worth and Houston and Dallas and San Antonio, have double-digit growth happening. What does the Texas grid need to be doing to handle the influx of people and businesses and just the robust economy that is represented by the state of Texas right now?
I have a quick thought because I always have thoughts. We're building new generation capacity in Texas very quickly. That's great news. We're not building the transmission capacity as quickly. So we need to build the infrastructure to enable the flow of electrons, not just the generation of electrons. Now, because we don't have transmission, what happens is we have cryptocurrency miners building right next to where the transmission isn't, where the power plant is, where electricity prices are cheap. But I think we need to build more stuff, and that's something Texas is quite good at.
And if I can add on to that, we have a huge amount of solar capacity coming into Texas over the next 4 or 5 years. And, I think wind is kind of, on the process of topping out. But, with that variability that we have in the grid, I think, over the next decade, we're going to need more baseload thermal generation. And there's no plans for that to happen over the next decade, really. That's something that is a little bit concerning for me over the long term within this grid.
Well, Garrett, I'm going to close us up because we're at 12:44. Garrett, Chris, Michael, I appreciate getting to do this with you so much. Our co-sponsors are shown on the screen. We appreciate their sponsorship. And I hope you will join me on our next Business Outlook next Friday, February 11th, where we will talk about technology and innovation. So thank you to all 500 of you that tuned in today. Hook 'em horns, and thank you again.